Fully insured, insured bears risk of adverse experience subject to state experience loss, premium taxes, so legal obligations. So all the legalities, all of the regulatory obligation is passed on to the insured instead of the ER reserve list plan. So yeah, paying the premiums, but they exclude the claim reserve component. So typically these premiums have this reserve component already built into them. But in this reserve list plan, you still have that premium, but you don't take into account the claim reserve minimum premium. So you fund the expected claims through a claims fund and then deposit them into an account as needed. So it's not a fixed monthly premium, right? It's not a fixed monthly premium. Only fund the expected claims through a claims fund. So it's similar to the level funding, except it's not monthly. It's not a monthly claims fund that you're putting this into, right? It's whenever these claims are necessary, you're putting it into the claims fund. Retrospective premium arrangement. So it's a reduced upfront premium, and then at the end of the year, then you look back, retrospective, look back, see how the actual claim experience came in, and then adjust the premiums depending on that. So if it's good experience, then the refund may be received. If it's a negative experience, then additional premium may be due. You increase the premiums for the following year. Self-insured takes the role of the primary risk taker. Premium tax, ACA fees are avoided. Complete control over the benefits. So you have offerings of provider networks work with EB consultants. There's flexibility of benefit design, timing of claim patterns, diagnosis, hospital contracts, internal processes. There is claims volatility, financial responsibility for favorable and unfavorable claims. Level funding, so it's a fixed monthly premium equivalent to covering expected claims. And you do receive the surplus. You do, depending on it, you do receive the surplus refund or credit if claims less than funded amount, or if it's greater than funded amount. And then aggregate stop loss will cover the excess, but if it's less than the funded amount, then you receive that surplus or that refund back. So level funding, you're paying this fixed level premium, and that fixed level premium consists of an ASO fee, and you're not completely eliminated from all ACA fees. Right? You are from some, but not from all. ASO fee, we have IBNR, and then stop loss, specific stop loss. Those are all the things that are taken into account when we think of the monthly fixed level fund that this goes into. You avoid some but not all ACA fees and stop loss contracts, specific and accurate stop loss manual versus experience rating, retrospective rating, three types: deficient recovery arrangement, unilateral arrangements with different deficit recovery arrangement. And so you have this premium that you're paying, and then it increases over the number of years since costs greater than premium. But the problem with this is the insurer risks being left in deficit if there is any termination of a contract. Then the fact that the claim experience is greater than the premiums. If there is a termination of a contract, then they're left with that risk. They're left with that risk of being in deficit. And we have unilateral assumes the deficit, insurer assumes the deficit, but the client assumes a surplus. So if there is a surplus of of let's say claims were significantly less than premium, then the client assumes a surplus. If there is a deficit, meaning the claims greater than the premiums, then the insurer assumes that deficit. There's no consequences for the client. Now, bilateral is the client assumes both the deficit and surplus, so must reimburse insurer for a full amount. So if the claims here are actually less than the premium, must reimburse insurer for full amount if the premium is greater than the claims, and then the client will get reimbursed for that. They will get the refund or surplus back. Now, for funding mechanism, now this is which one do we actually do? Which one do we do level funding? Do we do fully insured? Which one? That depends on federal state regulations, risk tolerance, how much risk tolerance does the ER have? What are other ERs and companies doing? What's the size of the risk that's being taken on for each party? Now, how do we do this plan design? How do we do plan design? Well, you look at the enrollment distribution, you look at the E contributions, so look at subsidy percentage with if it is when it is a percentage, it's typically what the ER is paying, what the ER is paying. And then ACA regulation. So small group we know is community rated, not experience rated, gender rating, health status is not allowed. And we know that ER must provide min essential coverage to at least 95%. And if one EE enrolls in exchange receives subsidy, at least 2,000 penalty for each FTE. So these are ways to protect and provide min essential coverage for EEs. Limits value of wellness incentives and payroll contributions. Have this mandate penalty where they must afford affordable and min value coverage and substantial penalty if at least one EE then goes on the public exchange and qualifies for an ACA subsidy. Geography, area, tobacco usage are allowable factors. Gender, industry, health status are not. And there must be some min loss ratio, min actuarial value. And again, actual value is how much does the plan pay for that plan, right? Plan sponsor over the total allowed costs. So costs covered by the plan over total allowed cost. We have must be affordable to avoid penalties, but there must be some essential health benefits for smaller groups. We have this restriction on lifetime and annual max. Max is on essential benefits that are removed, right? Requiring coverage to dependents age 26. We have this risk adjustment program. So we don't want insurers to competing on the risk of the population. So there is this transferring of funds where the insurer who has a riskier population receives funds from the insurer that who has a healthier population to make sure that they're competing on quality of efficiency and care, not just who has a better population. Right, pay or play, or right, which is either offer the coverage or owe the ACA penalties. New business underwriting, so you look at the age, gender, financial stability, and there is plan design ACA regulations. Renewal underwriting, so you look at plan design as the plan change, as the composition of the group change. Are there any risk changes, catastrophic claims that could affect next year? Now, choice, we know our inertia, don't want to make a choice from before. Provider networks, insurer admin issues, other health insurance coverages, are you eligible for those? Offering multiple choices, we have defined contribution concept, and it's not a percentage, it's actually just a fixed dollar amount. We have an advantage of favorable selection, right? If you do offer multiple selection, you may get healthy individuals on one plan. We do have satisfaction due to the choice. HDHP, high deductible, low premium, more consumer directed, more consumer responsibility. Cost conscious, but may delay the necessary services in order to avoid that higher deductible, which may lead to more chronic and more worse conditions in the future. We have this relative health status, so that's claims or premium, underlying health risk of the group. Now, if you just have the risk factor, what you want to do is you want to normalize it to 1. But if you have the relative risk factor, that is saying within that insurer group, within that entire insurer group, what is the risk factor of this group relative to the entire insurer? Relative to the entire insurer, and that is typically a calc with the average claim cost over the weighted average claim cost of the entire insurer. All right, that is relative risk. And now if you just see the risk factor, you want to normalize because you don't want to penalize an insurer for having more riskier patients. You want to say that, okay, if they were on the same level field, if they had the same population risk level of the population, then what will their claims expected costs be? And then you want to compare that after normalizing for the population. We have age gender analysis for measuring selection health status. We have these health risk assessments, which are questionnaires that are offered to these patients to determine their risk level and health status. Risk adjusters for claim predictions. HRAs, right? Health risk adjustments. Why do we need them? Because we don't want insurers to compete on the riskiness of the population. We want them to compete on quality and maintain quality of care and efficiency. And so we want to make sure that we adjust for the varying levels of health risk and status of different groups and members to normalize that. So we have classification. So that's pooling individuals with similar risk characteristics. So we have risk group A, B, C, and we're going to pool risk group A is a high risk, moderate risk, low risk. And we're going to pool those individuals with similar risk characteristics. You may look at demographics, lifestyle, behavior factors, medical history, pharmacy, and diagnosis info. Though medical history is actually limited by the ASA, you can't really look at medical history when you're determining these, but it is a classification scheme that gets used. And then once you have the classification, once you have the groups, then you do the risk measurement to quantify the amount of risk that each members in the groups actually have. So this is data. You want to make sure the data is on the same basis from all the insurers. You want to make sure the timing of the data is appropriate, and then the relative risk factors for all insurers are combined. Now the steps in the HRA, so you have this risk assessment, and then you have the payment adjustment. So after you know what the relative risk of each members in the group is, right? So you have group A, B, C, you know the risk factors of those, then you make the payment adjustments to reflect the differences in the risk. So this you have this base payment, and then you multiply those by the risk factors. Now, where is this a health risk adjustment used? Well, it's used in CMS. They use diagnosis codes. Pay amounts to insurers depending on the risk of the population. We have Medicaid, and that uses the diagnosis codes depending on their health for sick or Medicaid members. We have ACA individual small group. Then we have this entire risk transfer program that happens, risk adjustment program, risk transfer program that the ACA has. So that's health risk adjustment. And then employers are also using health status to set contributions, so sick or get more contributions. Now, what is the need for this? Equitable payments, ACA risk adjustment program, and then we also have fair comparisons among insurers providers so they compete on efficiency. And then we have coordination of benefits more than one party responsible for the claim, subrogation, and we have admin options for COB is pay and pursue and pay, and then we have the three, which are traditional model, full COB, 100% allowable, non-dupe, and government exclusion. Full COB is secondary payment, is the secondary allowed amount. So the allowed amount is okay. We have this initial claim. Now, what are we going to treat this as? What's the amount that we're going to take this claim as? Okay. That's what we're going to see is covered under this. And that's the secondary allowed amount minus the primary payment. Now, the secondary normal payment, and this normal payment is after the cost share, after the applied cost share. So that's the normal payment. And you remove the primary payment from that normal payment. And then now for government exclusion, secondary payment is the allowed amount by Medicare, and then it's the Medicare payment after applying cost share, right? And then you apply that benefit structure to that secondary payment. Why do we need TRA? Because of projection complexity. We know how the costs are challenging to project. We have these new technologies, aging population, reimbursements, new laws about healthcare costs are viable. And we know, that there's these different risks. We have model risk, we have design risks, so not including a variable in the model. We have data issues, so duplication issues, missing data. We have errors in so perhaps like a formula or a calculation. We have the starting value, which is the initial value of what you're projecting all of your assumptions from, and then you have the assumptions. So trend, your util, your how much inflation, and how much all these factors will change. You have provider changes, contract changes, changes in demographics, migration adjustments. These are all assumptions that you make on top of your starting value to get to what your expected PMPM will be for next year. Now we have random variation. So this is when one individual moves from, let's say, one part of a subset of claims to another part of a subset of claims, but all the other groups are as expected. So you have this one random variation, you have this one minor subset of individuals who shift buckets. Incredible, like one individual has an extremely high cost claim, and that occurs. So that's random variation. Now, TRE limitations, we need make sure we validate assumptions. There's sometimes going to be double or undercounting. And then we know that there could be incurred versus paid claim lag. So that depends on the type of claim, complexity of the claim. And then entities in SL marketplace. So we have the administrator, we have the prospective insured, F advisor, underwriter, risk taker, broker, producer, plan beneficiaries, and providers. Okay, so the insured goes to the advisor, says, okay, we need this quote, we need this plan. Then they communicate that out to the plan administrator, the underwriter, and say, okay, give us a quote, these are the needs, and then they provide that quote, and then that gets sent to the advisor who sends it back to the insured or the plan sponsor. And we have process for our SLI. So we have financial advisor, underwriter, and then paying the premiums. Plan admin gives the premiums to the stop underwriter. Now, why do we need this functional approach? Because these are a significant part of total comp and labor costs. Systematic approach, make sure these benefits are three C's: current, compliant, and competitive integration with other existing plans. We have this total comp philosophy of is it a needs oriented philosophy looking at the needs of the EEs, or is it a comp service oriented philosophy looking at the comp or service or tenure? And now what's this functional approach? So you classify into functional categories, classify the EEs themselves, what is currently available, so the benefits currently available, what are the gaps in those current and overlapping plans, and you consider recs for changes in the current plans, estimate the cost or savings for each rec, evaluate what are the methods of financing, consider cost savings. So what's currently available? Then you identify in what's currently available, what are the gaps, and then you consider recs for changes in those current plans. So what's currently available, what are the gaps in what's currently available, and then you consider the recs for the changes into what's currently available with the other plans. And then you estimate cost savings for each rec, and then you evaluate methods of financing. And then you say, okay, are there any CSs or are there any containment techniques? And then you decide, okay, these are the appropriate financing methods and appropriate benefits. And you implement changes, communicate those to EEs, and then you periodically evaluate. So we know that BD has plan design responsibilities, plan delivery. So design is order. What are the objectives we want to fulfill? What are the market conditions? What are the cost culture EE needs? So this is developing that design, making sure you have the objectives, guidelines, needs taken into account, then you deliver it, which is through the implementation. So you deliver it through the EE orientation, you deliver it through clarifying if there's any questions. And then formulation is during the actual process of the plan itself. Denial of a claim, waiting period questions, customer service questions, those get answered during the policy period itself. Then in communication, so SPDs are important because you're able to communicate what the provisions of the plans are and eligibility requirements and documentation of those provisions in a way that's understandable to the average plan participant. Summary of material modifications, annual report, and you apply tech. So this is abilities pro reports, check how claims are coming in, cost management if you want to implement CHD fees, management reporting, and you compare that with competition. So you compare actual costs, benefits under different circumstances. So if this cohort was with them, what benefits would they offer? And then you compare the benefits and plan features feature by feature, employee surveys of the industry. That's comparison with competition. Regulatory and legal compliance, and then external environment is environmental factors. So you check also the competitive conditions, market conditions, government policy, and then demographic shifts, aging of workforce, and then new tech. So new techs, new products, organization structures, demo shift, gov policy, outsource. If you do want to outsource, going to be fragmentation. Going to be fragmentation, but it could also lead to improvements. Now, how do you determine ER's financial contribution to these benefits? Well, it's comp philosophy. How much do we actually want to allocate toward this? What's the budget? What's the competitiveness comparison to other ERs, collective bargaining, and then making sure there's no limit on how much EEs can contribute. And we want to make sure ERs actually also provide adequate assistance to ensure compliance with ACA rules, legislation, and regulatory issues. Defined benefit, which is a defined percentage of what the EE should pay. Set percentage premium, most common. Defined contribution, fixed ER contribution. fixed subsidy amount, and then regardless of plan. Now, levers of this income-based, and then moving from single to average hurts individuals who are lower paid because now they pay more from before, and higher paid pay less. And we have this dependent subsidy that there's a greater level of contribution if you want to cover the dependents. And there's health incentives that changes payroll deductions based upon to encourage healthier behaviors. And then health spending accounts again in Canada again. So you can think of this as it is a fixed amount that is determined for the year that the ER allocates to this and can be used for medical expenses. It's irrevocable, right? You can't change it. But if you do have certain of these life events, then that election could be changed. And design consideration, right? Type of approach, impact on other benefits, funding, changes during the year. Do you want it? You could just have a standalone HSA. You also have this personal account, which is for non-medical expenses as well. Now, advantages of HSA is that there's a fixed ER contribution, tax friendly, it's simple to admin, flexibility, plain documentation is straightforward. And the disadvantage is there's no inadequate coverage for these large expenses. Right? Some healthy, some more sick needs. If it's a fixed amount, it's a fixed amount. Some may need more, some may need less. And we have this private exchange, which is typical to Aon or Mercer. And they include greater choice, predictable ER costs, better shopping experience, competition among insurers. And we do have these member buy downs. So they tend to choose cheaper plans with lower premiums, higher deducts than they would in a traditional plan. Now we have public exchange. So public exchange, ACA marketplace, ACA compliant plans and individuals. Whereas for private, it's it's an exchange created brokers, consultants run by private companies such as Aon or Mercer. And they have this online recommendation software, and benefits admin is easier. Tailored to ER, a greater greater EE choice, greater complexity for ERs, though EEs may pay more. EEs lose plan control to the exchange. There's some decision fatigue, choice paradox with that. And yeah, that's we have additional expenses, right? Because of for the exchange operator financing. And then HDHP, we have this aggregate deduct. If you have a family plan, we have this embedded deduct for family plan. And then the min of the remaining individual deduct, family deduct, is what you take into consideration. Main criticism is that doesn't work well for emergencies, not going to be cost conscious for emergencies. Chronic conditions may reach OOP max early, so they may delay or skip necessary care. Now, reasons HDHPs actually save, it's because plan design more cost-conscious consumers, relative health of individuals selecting HDHPs, and these could be better if we have cost transparency. We lengthen consumerism, pre-funding HSA account, discussions between providers and patients, and drug coupons were limited, could be limited, but they're directly provided to enrollees from drug manufacturers to reduce these costs on brand drugs. Now, future of HPs, you increase the contribution limit because there is a limit, and you allow for these non-major medical expense items, so fitness equipment, and then you expand coverage of these major medical usage of HSA funds or premiums over the health supplies. So you can use these for premiums for other insurers, but not for the HDHP plan that you are currently in. HSA health savings account owned over EE owned. You can carry forward it throughout jobs. HRA reimbursement agreement. This is employer funded only. We have data collection. What data do you want to collect? Summary plan description. Again, this is a documentation description of the provisions of the plan in understandable language to the average member. And employee eligibility of plan designs, available costs, census file. Guiding principles like the philosophical strategies that adhere to the guidelines. Best industry solutions maximize efficiency, and the specific objectives are quantitative. Right? They're numerical. We'll stop there.